welcome to how momentum can reduce risk and enhance returns in your portfolio. My name is Dieter Scherer. I'm a quantitative investment manager and certified financial planner and founder of RealizeYourRetirement.com. Today we are talking about momentum, but first let's ask, what is momentum? Well, momentum is a very hot topic in research and quantitative finance because, according to the efficient market hypothesis, it shouldn't exist. But its effects are pervasive, and it has been used by many of Wall Street's elites to make billions upon billions of dollars in profits for their hedge funds. In fact, it's so pervasive that even Nobel laureate Eugene Fama, the creator of the efficient market hypothesis, says that momentum is the premier market anomaly. Now, an anomaly is essentially a factor of stock returns that is unexplainable using theories that assume a completely rational market. And being the premier anomaly means that it creates the largest excess returns versus the market when compared to other anomalies such as value investing. So, the term momentum was borrowed from Newton's first law of motion, wherein an object in motion tends to stay in motion unless an external force is applied to it. Now, I don't want to lose you here, so just bear with me. An asset or market in motion also tends to stay in motion. Basically, momentum is the observation that stocks tend to continue in the same direction that they've been trending over the recent past. So stocks that go up tend to continue going up, and stocks that are going down tend to continue going down. So essentially, trends tend to continue. And we can use momentum to determine which stocks to purchase in a portfolio, because stocks with positive momentum tend to have positive returns over the near future, the next 1 to 12 months, and vice versa for those with negative returns. And typically, researchers use 12-month returns to determine the magnitude of momentum of a stock. So a stock's 12-month momentum is equivalent to its returns over the past 12 months. Now, as you can see here, there are numerous behavioral explanations for why momentum occurs, and each bias has its own name and psychological explanation behind it. For today, let's not get lost in the weeds, and the simplest explanation would be that rising prices attracts buyers and falling prices attract sellers. Pretty simple, right? Most of the time when the stock market is going up, people tend to crowd into the markets and wish to buy at any price. Conversely, when the market is going down, people tend to want to get out of the market and sell at any price before it hits the bottom. So there are two types of momentum we're going to be talking about today. And the first is absolute momentum. And absolute momentum is the idea that you let your winners run and you cut your losses early. So it basically asks if the momentum of the stock is positive or negative. If it's positive, then invest in the stock. If it's negative, then don't invest in the stock. So what's the benefit of absolute momentum? Well, absolute momentum works well as a risk management tool. Most of an asset's losses come when the absolute momentum is negative, meaning that the past 12-month return is negative. So if you avoid investing in the asset when it has negative momentum, you can improve returns and reduce risk by simply losing less during those periods. Let's look at a basic idea about how this works. Okay, say we start off over on the left, down at the bottom over here. And as we progress up to here, from the bottom, there is upward movement, meaning we have upward momentum, positive momentum. And so at this point, we have positive momentum. And we're going to ride out this wave of stock returns until it gets past its peak, because it's very difficult to determine when the peak of a stock market is, but we can react to it once it starts declining in price. So once it gets to this point and it has negative momentum as measured from the peak of that graph right there, we would exit the position. And the benefit is that while we don't have perfect timing, we didn't get in at the very bottom or get out at the very top, we get all of that return in the middle. And so we would either sit out or go to something much more conservative than stocks during the interim until momentum is positive again, as measured from the bottom of that trough. And so we have positive momentum, and then again, the cycle repeats, and we'd ride that wave out until it has negative momentum as measured from the peak. And again, we would try to capture that nice return between those 2 points. So how does absolute momentum do against, say, the S&P 500? Here's a little study I put together that compares the S&P 500 versus the S&P 500 with absolute momentum risk controls. So here it is from January of 1927 to the end of September 2015. And as you can see in the blue, S&P 500 with absolute momentum allows you to miss out on a lot of the huge downturns. For example, the Great Depression, the tech bubble, and the financial crisis. Now, all this does is say if the absolute momentum is negative, we're going to move from stocks, the S&P 500, to bonds, the aggregate bond index. And it does pretty well over time. As you can see here, if we compare the two, the growth of $100 in the S&P would have grown to $457,000 versus $1.2 million if we use the absolute momentum risk control as protection. And that would improve our annualized return from around 10% to 11.2%. Volatility, which measures how much the asset fluctuates, would be reduced from around 19% to 12.9%, so around 13%. And then downside volatility, which only measures how much an asset fluctuates on the downside, would be reduced from 14% to 10%. Now, the Sharpe ratio and the Sortino ratio both measure risk-adjusted returns. So how much return am I getting per unit of risk? And as we can see here, the Sharpe ratio improves once you add in absolute momentum from 0.35 to 0.6. And the Sortino ratio, which measures the risk-adjusted returns only using downside volatility, so only when returns are negative, improves from 0.7 to 1.07. The worst month is also better for the absolute momentum than the S&P 500. Worst month improves from negative 29% to negative 22%, and the worst year improves from negative 67% to negative 32%. Maximum drawdown, which is the maximum loss in the portfolio, improves from negative 83%, which occurred during the Great Depression, to negative 48%, which the difference between losing 83% of your money and roughly half is night and day. 83% is absolutely catastrophic, but 48%, while I definitely wouldn't want to invest all of my money in something that could lose 48% of my wealth, it's recoverable. Essentially, you would require several 100% in returns to get back to even with a max drawdown of 83% versus only, in air quotes, 100% to get back to even with 48% losses. So the max drawdown sum basically says we're going to add up all of these maximum losses and see how consistent things are over time. Is it just one big loss, or is it a lot of losses over time? And it allows us to compare two different strategies. So the maximum drawdown sum improves from negative 13,000% to negative 7,600%. And basically, this shows us that adding absolute momentum to the S&P 500 not only improves its maximum loss, but it consistently has lower maximum losses through time. And finally, we're looking down here at the months positive. So over on the left, we see that only 62% of months are positive for the S&P, but around 65.5% of months are positive once you add in absolute momentum. That's a big improvement, which compounds over a year, over every year, to make the years positive improve from around 74% to around 78%. Okay, so absolute momentum is just one type of momentum. Relative momentum is the other type of momentum. This has been the one that's been studied more broadly in academia, but offers less in terms of risk reduction. So relative momentum is essentially, I'm going to rank the different assets in my portfolio, and I'm only going to buy the winners, and I'm going to avoid, or I'm going to short sell, the losers. So let's look at an example of relative momentum. Say I have two companies, Widget Factory and Technology Corp. Widget Factory has a 12-month past return of 5%, whereas Technology Corp has a 12-month return of 50%. Remember, momentum is equal to whatever range of past returns that you're using. So in this case, the 12-month momentum is equal to the 12-month return. So because the return of 5% is lower than the return of 50%, we would buy Technology Corp because it has higher momentum relative to the other stock, and we would avoid or sell short Widget Factory. That's the idea of relative momentum. You only want to buy winners and you want to avoid or sell losers. Now let's look at how this works on a graph. Here we have in pink high momentum stocks in the S&P, high momentum stocks in the pink. Then we have the S&P 500 in the light blue. We have the consumer price index, basically inflation there, as a reference. And then we have the low momentum stocks, the loser portfolio, in green. As you can see, high momentum stocks that have the highest past returns significantly outperform both the S&P 500 and the low momentum stocks that have the lowest past 12-month returns significantly underperform the S&P 500 and lose a tremendous amount of money to inflation. So let's look at the numbers here. So the ending value of $100 from 1927 to December of 2014, that's an error up there, but it's 2014, not 2015. For the S&P 500 would be 476,000. Momentum would have grown to 94 million, and low momentum would have lost money and fallen to $26. That corresponds to annualized returns of 10% for the S&P 500, around 17% for high momentum stocks, and negative 1.5% for low momentum stocks. Volatility, again, how much it fluctuates, 19% for the S&P 500, and these will be slightly different than the numbers you just saw for the S&P 500 because it's on a different time period. 19%, 22.6% for high momentum. The higher returns have commensurate higher volatility than the S&P 500, but what we also see is that low momentum stocks are not only the lowest returning, they have the lowest returns, but they also have the highest amount of risk. And most of the additional risk from low momentum stocks comes from their movement on the downside. So the Sharpe ratios, obviously the high momentum stocks have improved Sharpe ratios and Sortino ratios versus the S&P 500, meaning they offer better risk-adjusted returns. And then the low momentum stocks are just terrible. They have the lowest risk-adjusted returns. You should absolutely avoid, or in some cases, for sophisticated investors, short these. The worst month for the high momentum and S&P are about equivalent. The worst year, again, 67% for S&P 500 versus 60% for high momentum stocks. Not a huge difference, but low momentum obviously is the worst one once more. And then the maximum drawdown is slightly improved for high momentum, but if you look over on the right, low momentum stocks have an insane loss of 97%. And as you can see, they have more consistent losses than either the high momentum or S&P 500 portfolios. So both high momentum and low momentum stocks are part of the overall market. So in this case, part of the S&P 500. And by breaking them out, we can avoid the ones that offer the poorest returns, the low momentum stocks, and concentrate on the stocks that offer the highest returns with only marginally more risk. And again, months positive are improved for the high momentum stocks, as are years positive, and they are lower for low momentum stocks. Now, it's important to look at both extremes of a factor when you're analyzing it, because what you want to see are that the top 10% best are far better than the bottom 10%. And that's what we see here when we compare the highest momentum stocks versus the low momentum stocks, and we also compare them to the S&P 500. So this has been a lot of information to take in, but I also want to highlight that momentum is everywhere. It's not just in stocks. It's across numerous asset classes, across different time periods, and there have been studies that have gone back 200 years showing how pervasive momentum is, and it shows up in every market across the globe. So adding momentum properly to your portfolio, and specifically combining absolute and relative momentum so that you get the best of both worlds, can significantly enhance the returns of your portfolio while simultaneously reducing the amount of risk that a normal stock portfolio would have. And it also allows you to capture more returns with less risk than simply dividing up your portfolio between stocks and bonds. So I hope today's video has given you plenty of value and a lot to think about when you're thinking how you should invest your own portfolio. If it has been of value, I think you'll learn a lot more by subscribing to my newsletter and getting access to an exclusive 4-part video course I've put together called How to Protect and Even Grow Your Portfolio in Any Type of Market. In there, we'll go through the biggest myths of Wall Street and debunk them one by one. Then in the next video, we'll go through how average investors sabotage themselves and how the world's elite investors, the hedge fund managers and institutional managers, manage their own portfolios in their own funds, and how you can implement those ideas, those principles into your own portfolio. And then in the last video, we'll put it all together to see how a diversified portfolio that uses some of the best techniques from both research and in practical use would perform. So click the button. There should be a link over the How to Protect and Even Grow Your Portfolio in Any Type of Market. Click that and it'll send you to a page where you can subscribe to my newsletter and get access to this course. Additionally, if you're on my blog, you should see a similar form at the bottom of the page. Thanks a lot for watching, and should you have any questions, feel free to contact me using the contact form on this page up at the top of my blog. Again, thanks for watching and have a great day.